Welcome to Accounting 202, Part 1. Accounting 202 is the second course in the three-course accounting series. Accounting 201, Accounting 202, and Accounting 203. 201 and 202 are financial accounting, and 203 is managerial accounting. Why do we put business students through so much accounting, especially if you're not an accounting or finance major? Accounting is how businesses communicate their results. Whether they made sales, hopefully that they made profits. Accounting tells the story of the business. It tells where the business got its money, how it was financed, whether through loans or through stockholder investments, how they spent those initial investments in terms of equipment, building, land, software, computers, and how they turn those investments into sales and profits. 201 is considered an introduction to accounting principles and concepts, journal entries, the accounting equations, statements, analysis. And you need to be really strong in these concepts because we're really going to build on them fast for Accounting 202. And you do have an accounting, where we're going to do a little bit of review in this presentation, but you will have an Accounting 201 review packet due next week. And that's a good way to go over a lot of the concepts that you learned in 201. Let's do some housekeeping here. The basics. The textbook is the same textbook that we used for Accounting 201. If you rent it from the bookstore, it will be cheaper than buying it. The syllabus, please print it out, make a copy of it, and read it. You will be quizzed on that this week. There's also a printed schedule. Please print that out as well and read it. While I do follow the calendar as well, the printed schedule gives you something to refer to with all the deadlines in it at easy access. Chapter handouts, print them out and use them with the PowerPoint slides. I incorporate a lot of demonstration problems, practice problems, journal entries, and the handouts are a good place for you to use and fill out as a worksheet and refer to it as you do the homework. PowerPoint slides, I recommend you print them out and make notes on them just as if you were sitting in a classroom. And then obviously I have these narrated PowerPoint slides as well. And they're a good source to get just extra information about the material. The format for the course, and do print out the schedule. The format for the course, we have multiple deadlines for every unit, every chapter, every week. The first week is a little different. I have you do introductions, and you'll post those on the discussion board. There's a course overview quiz due this week under assessments. Each chapter has reading assessments due every Tuesday night at midnight. There's homework for each chapter due Thursday night at midnight. Please use Wiley Plus. It's a free online homework manager software. And there's instructions on that under the Unit 1. Discussions about the chapter are due weekly. You need to not only post a discussion, you need to read everybody's posting and respond to at least one posting. And then there's a chapter quiz due Sunday night at midnight on each chapter. And this is a way that we have you stay involved in each chapter. We're not really looking at you to cram the night before the test. We want you to be involved all the way through the chapter. Every unit, and there's about 2 chapters per unit. Every unit has some mini projects. At the end of every unit, I will issue you a practice exam. Again, you need to participate on the discussion board as you work through the solutions to those exams, those practice exams. And then every exam is proctored on campus. If you are unable to come to campus, you need to take it at an approved testing center, and fees may apply in that case. Proctored exams on campus are free. And if you do need to request approval for a remote proctor, get that in by the 10th day of the course, and there's a form to fill out on the home page for that. Print out your syllabus and read it. It has a lot of information on the course, how I assign the points and the assignments, course outcomes, major assignments, my policies, the college's policies, and my background. So in Accounting 202, we are going to really go down the balance sheet. We've learned the basics of journal entries, T accounts, statements in Accounting 201. Now we're really scrutinizing the balance sheet, starting with long-term assets, because we've already done inventory, accounts receivable in Accounting 201. So we're going to continue on with it. Long-term assets, current and long-term liabilities, and how they affect sales and profit. We're also going to, under liabilities, we're going to go into the area of bonds. And bonds are a way for companies to raise money quickly, differently than selling stock. They are a loan to the bondholder, from the bondholder to the company. We're going to talk about how companies account for that and how they can use that sort of financing to grow their business. We're going to look at time value of money. Money now is worth more than money later, so it's reasonable if we borrow money from a bank and pay it back in a year or 2 or 3 that the bank will charge us interest. Invest your money wisely now and you will earn interest. We're going to look at the cash flow report, and you're going to use the cash flow report to really analyze businesses in a different way than you have done with the income statement and the balance sheet. And the word on the street is cash is king or queen, and companies that do not have ready access to cash do not survive long without it. Stock transactions. How do companies use stock? How do investors make money in the stock market? You will be looking at the stock market a little bit in this course as we watch how companies' stock may be sold at a certain price and yet appreciate in value based on how the company is doing. We will, if we have time, calculate your own retirement. What would you need to live on now if you retired? If I came along to you and said, I am going to give you an annual income to live on now, what would that annual income be? We're not talking about being a millionaire. We're talking about a realistic income, something that's within your reach. And some of you are already earning a healthy income now. Maybe some of you are not. So let's say right now some of you are earning anywhere from $10,000 a year to $80,000 a year. Could you, if you retired now and somebody gave you $80,000 a year, could you continue in your lifestyle? And if not, how much more would you need? And that's a question to ask people that are willing to talk about money. What's a realistic annual income for a retiree? And if you have family members or friends who are willing to share, that's a really great question because it does put into perspective your long-term goals. And we will, in a small project, judge a company's financial healthiness, analyzing their income statement, their balance sheet, and their cash flow, and deciding which company is the best investment. Okay, are you ready? Let's start some areas that we should review in Accounting 201. So print out your course pack for the overview, and I've got some sample journal entries in there. But before we get there, let's go over just some concepts from 201. What do accountants do all day? What are the 3 major responsibilities of accountants? What are the 4 accounting statements? Give up? Hopefully not. What's the first statement? Usually at this point somebody from the class will volunteer balance sheet or income statement, but what are the order of those statements? Income statement has to be done first because information from the income statement is used on the next statement, which is the statement of retained earnings. Statement of retained earnings has to be done second because information from the retained earnings statement is needed to prepare the balance sheet, which is prepared next. And finally, the cash flow, which uses information from the balance sheet and income statement as well. What is an accounting transaction? It has to be an exchange. For example, if an airline company in Korea places an order with the Boeing company for 10 787s, is that an accounting transaction? Not necessarily. Unless there was an exchange, there is no transaction yet. Of course, the Boeing company is going to cheer and maybe issue a press release about the order, but there's no journal entry that'll be prepared because there was no exchange yet. If, on the other hand, Boeing ships one 787 to the Korean airline company, then there's an exchange. And what was exchanged was an airplane, and what will be given is money for payment of the plane, or a promise to pay through accounts receivable. So as we analyze business events, the question is this an accounting transaction or not? And what are the steps? If we determine that it is an accounting transaction, what are the steps involved? Well, the first step is to create a journal entry. Second step is to post to T accounts. So if you had an accounts receivable and cash involved in a journal entry, each one of those accounts would have its own T account. And then at the end of the period, whether it's the end of the month, end of the quarter, end of the year, you would add up the balance in the T accounts and calculate an ending balance. And it would either be a credit balance or a debit balance, depending on which side was bigger. And you'd post that ending balance to the trial balance, all the credits and all the debits. And it's called a trial balance because at the end of the postings, the trial balance, the total of the debits, should equal the total of the credits. And if they don't, you've made a mistake. And you go back and check your work. How do you title each of the four statements? First line, always company name. Second line, always title of the statement. Third line, date of the statement. Not the preparation date, but the date the information was issued. So if you create the income statement on January 15th as of December 31st, for the period ending December 31st, the date on your statement would be December 31st. What are the major categories of accounts? Now I want you to think of the accounting equation. Assets equals liabilities plus stockholders' equity. And I always like the expanded equation. Assets equals liabilities plus stockholders' equity plus revenue minus expense minus dividends. Can you name some sample accounts under the asset account? Of course, the beautiful account, cash, then accounts receivable, maybe inventory. Can you name more accounts? And if you haven't done it already, this is a really good time to print out that list of common accounts in your handouts list and really familiarize yourself with that list. You want to be able to, when I name an account or when you read an account, you want to know what category it falls into. And as we learn new accounts, you want to automatically update that list if the account is not already there. Why do we issue adjusting journal entries? Why do we have to? Go back and look at Chapter 3 and look at the adjusting journal entries for the supplies accounts, for accounts receivable, for payroll. These are entries that we have to book that don't necessarily have a document that generates the entry. Take a look at the closing journal entries. What are the temporary accounts in that accounting equation? Which accounts get refreshed at the beginning of each year? And those would be revenue, expense, and dividends. Those account balances are swept to retained earnings at the end of the year. How do you purchase inventory? What's the 4-line journal entry for selling inventory? When we have a service transaction, we just debit cash and credit service revenue, or we debit accounts receivable and credit service revenue. But when we sell inventory, we debit cash or accounts receivable, credit sales, and let's say that sale was for $100. That would be $100 in each category. Debit accounts receivable $100, credit sales $100. We would also have to do a second pairing of journal entry, debit cost of goods sold and credit inventory, to get the inventory off of the assets and expense it to cost of goods sold. And of course, the inventory is going to have a much lower cost than the selling cost, unless you're selling it at a loss. Understand the differences between the perpetual and periodic inventory methods. Understand average cost, FIFO, LIFO, how we use bad debts and allowance for doubtful accounts associated with accounts receivable, and the cash principles and internal control. Let's practice. Pull that handout out and let's do some sample journal entries. This concludes part 1. Please go on to part 2.